So this is chapter 31, Public Limited Company. The process of a private limited company changing to a public limited company is called flotation. PLC at the end of the business name signals that the business offers shares for sale to the public on the stock exchange. PLCs can raise large sums of money through selling shares publicly. Each PLC must have a minimum of 50,000 share capital and have at least 2 shareholders. Advantages are limited liability, able to raise large amounts of capital through the public sale of shares, may be viewed as prestigious, which can improve their reputation. Media are actively interested in the activities of PLCs. Business accounts are available to view by the general public. That's the disadvantage. Other disadvantages are vulnerable to takeover, can face scrutiny from the media, expensive and time consuming to set up. Distributing dividends lowers the amount available for reinvestment, like retained profit. So this is finance for growth. So this is sources of finance for growing and established businesses. There are 2 main ways that growing and established business can raise finance: from internal and external sources. Internal sources refer to money that is available from within a business. There are usually limited amounts of internal sources of finance that a business can access. There are 2 main sources of internal finance: retained profits and selling assets. Retained profits, this is the most important source of finance for large, established and profitable businesses. Instead of profits being distributed to owners or shareholders, profits can be kept within the business for reinvestment. These profits are called retained profit and are used by a business for growth and development. Advantages are no interest or repayments, does not dilute the ownership of the business, readily available to a successful businesses. Disadvantages: the amount available may be low and therefore business growth can be slow. Retaining too many profits can anger shareholders who will receive a lower dividend payment as a result, only available to successful businesses. Selling assets is another internal source of finance. Selling spare or unwanted non-current assets such as spare land, building, machinery or equipment that are no longer needed by a business can result in extra finance being generated on a one-off basis. Alternatively, businesses can sell an asset and then arrange to lease or rent it back from the buyer. This is called sale and lease back. Advantages: can raise cash from an asset that is no longer needed. If a sale and lease back arrangement is arranged, the business can still use the asset. No interest charges or dilution of ownership. Disadvantages: the value of a business will reduce as the business will no longer own the asset. The value gained through the sale is likely to be less than the value the business paid for the asset. Not a sustainable source of finance. Finance will be raised on a one-off basis. If the asset is sold, it will no longer be available to use within the business if it is needed later. Sale and leaseback will result in regular payments being made to use the asset, which will increase costs. External sources of finance. External source of finance refers to money that is raised from outside of the business. External sources enable a business to access larger amounts of money that may be available from internal sources. Loan capital, they were covered in detail in theme 1. Loan is an amount of money borrowed for a set period of time with an agreed repayment schedule. Repayments of loan will involve interest, and businesses will need to prove to a bank that they would be able to make loan repayments on time. However, no control will be lost over the business with the bank loan, and businesses will be able to plan as they will know how much their repayments will be each month. Share capital is another external source of finance. This is finance raised through sale of new shares. Advantages are funds are permanently invested in the business. No interest or repayments need to be made. A PLC can attract wide range of investors through the stock exchange. Dividend payments are optional for the businesses. Disadvantages are loss of control over the business as the number of shareholders increased dividend repayments resulting in less money available for reinvestment.